Today I'm going to talk about something very powerful, your first $10,000. Or maybe it's not the first $10,000 you've ever invested, but maybe you want to invest a nice sum like $10,000 this year. This isn't just about dollars, it's about momentum. You're holding $10,000 and wondering how to invest it wisely in 2025? I'll show you exactly how I'd do it step by step. No get-rich-quick nonsense, just timeless principles and smart moves that actually work here in the real world. I'm Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. This video is going to have 6 important sections with timestamps below because I know you'll want to come back to these specific sections at different times of your investing journey. So let's get started. Section number 1, mindset first. You have to think like an investor. Before you click buy on any stock or ETF, you need to ask yourself the question, what's my goal? If it's just to make money, you're probably going to click any shiny object that comes your way and probably going to panic when things drop. Your real goal? Build a portfolio that works with time, not against it. That means thinking like an owner, not a trader. That $10,000 isn't a lottery ticket, it's a seed. Your job is to plant it where it can grow and leave it alone long enough to do so. In 2025, the tools are better than ever, but the biggest edge? Patience and discipline. Section number 2 is all about where the money actually goes. So here's the allocation of what I would do with the $10,000. The first one is the big chunk, and this would be 40%. And this is something that I usually term foundational, or at least the market average. And for this, you definitely want to be doing this in a very solid ETF. There's 2 specifically that I like here, and the first one is the total US stock market. You're buying over 4,000 companies with one click. It's low cost, diversified, and historically has returned about 8 to 10% annually. This is your growth engine, and for this one, I recommend VTI. For the S&P 500, which is that second choice, you're buying 500 of the US largest companies by market cap and a fund that's held up for the life of the stock market. It keeps the best companies in and kicks out the companies that are underperforming. It also has historically returned about 10% on average per year with dividends reinvested. For this, I like VOO, VOO, or SPLG, or SPY. The second piece of the pie, this is going to be for 20%, would be value investing. This could be looking at something that's producing cash flow through dividends or just something that's safe and sustainable. This is so important, but so many people skip over this one for the much shinier objects down the road. I'll tell you, one of my biggest regrets that I always hear from my clients that are 70 years old or over is that they wish that they would have kept at least a portion of their portfolio in something like this that was more so towards value investing versus just always going for that heavy growth. If they did this, they wouldn't have experienced as big of swings, and so their portfolio would not have dropped as much. Some great funds here would be SCHD or VYM if you like the dividend aspect. Or you can go with a safer sector ETF like XLU, which is the Utilities Select Sector Spider Fund. Historically, utility stocks are among those with the lowest volatility compared with other fast-moving sectors like technology. Specifically in this section, what you're looking for is low volatility, which just means it's not going to go down like crazy. It also means that it's not going to go up like crazy either, but that's okay. We're going to get to that in the next section. If you want to have something with a low beta or you want it to be very low volatility and safer for the portfolio, but you're not necessarily looking for dividends, especially in a taxable brokerage or something, one that I've been adding to like crazy is Berkshire Hathaway. It has a lower beta than the S&P 500, meaning it's less volatile, but actually has outperformed the S&P 500 as well. This is definitely earning a bigger portion of my portfolio these days. Number 3, this one is another 20% slice, and this is actually all about innovation and growth. But for this one, I want you to keep it broad. The prior little slice was all about safety, but still has a little bit of upside. This one is about adding a bit more risk to hopefully gain a bit more reward in the portfolio overall. Remember, we're still keeping it broad here though. We want a broad ETF that has a lot of technology and AI, but it's not only technology and AI. For this, I like SCHG, QQQM, and VUG. When we look at SCHG, you can see that yes, it has mostly technology in the portfolio, but there's still a fair amount of communication services, consumer discretionary, healthcare, and financials. These types of funds definitely have a bit more risk than those prior two that I just spoke on, but also have a great track record, especially over the last 10 or 20 years, mainly because it's all about investing in things that are future growing, and especially one that has a bunch of technology and the newest types of things going on in healthcare or communication services. That's just where the world is going, so it's important to invest in something like that. This type of fund, though, the reason why I keep saying keep it broad is because we don't want to go too sector specific on such a big portion, like 20% of the portfolio, only because we don't know what exact sector is going to do amazing. It seems like technology and AI is probably going to be great over the next 10 years or maybe forever, but we don't know that for certain. So keeping it broad, but keeping it growth, make sure that you're a little bit safer in this section. But now for number 4, this one is going to be that higher risk, possible higher reward, even more so than what we just talked about. And for this, we're going to have a smaller portion, so this is going to be 10% of that $10,000. This is where you tap into the future hardcore. Artificial intelligence, chips, biotech, keep it small but targeted. VGT is one where it's literally all technology, so you could go that route. Or SMH is one that's even more specific. It's all semiconductors, so if you believe heavily in AI, this is one of the best ones. Or in this section, or at least a part of this section, you can go very speculative and hit things like crypto or Bitcoin. Just make sure to do very solid research into whatever it is that you're thinking about investing in. Do yourself a favor and be very disciplined here. Keep this to 10%. These types of investments can make your whole portfolio come crashing down and your life savings drop fast if you put too much of your portfolio in these. And now for that last 10% of this $10,000, I would suggest that you do keep it in some cash in like a high yield savings account or even the money market account within your investing account, or going for something like bonds or short-term treasuries. This is your safety net. You want some liquidity for emergencies or opportunities without needing to sell when the market's down. This could be your high yield savings account, like I said from before. I personally like the 360 savings account from Capital One, or something like SGOV is a great short-term treasury to hold your money in as one of the only bonds that I actually like. Section number 3, how to actually set any of this up. Here's how you're going to put that plan into motion. First place I would go would be to open a Roth IRA if you're eligible. That's tax-free growth for life. If not, use a taxable brokerage, or even in conjunction with the Roth IRA, adding in that taxable brokerage will at least give you some short-term liquidity. I like Fidelity, Charles Schwab, or Vanguard. They all have low fees, clean interfaces, and no nonsense. Set up automatic contributions if you're still adding money. Invest monthly. Don't wait for the perfect entry point. Time in the market beats timing the market. Especially if this is your first $10,000 that you're investing, I'm hoping that this is just the start, and then every month after that, you're able to add to it. Section number 4, this is what not to do. Please pay attention here. Don't go all in on a single stock, or even a single ETF, to be honest, even if it's popular. Now, the one possible ETF or mutual fund that I would say is totally okay to go all in on would be that first section, that 40% section that I was talking about from before, the foundational section. So either the total US stock market or the S&P 500, either one of those, that's the only thing I would ever tell somebody that I would be okay being 100% in. But since you have options and it's so easy, you might as well diversify just a bit based off of some of the things that I just talked about. Don't YOLO into crypto or meme hype. Volatility kills beginners. You're going to hear about this cool crypto or meme stock that your friend put $10 in and it turned into $1,000. And that's crazy. That probably will only happen once in a lifetime. To most people, it never happens. Most of the time, that type of stock or crypto literally goes all the way to zero and you lose all of your money. And that's a tough hole to dig yourself back out of. Don't sit in cash forever waiting for a crash. Markets rise more than they fall. This would be called timing the market, and most people just have this feeling that, oh, it's gonna go down, so I'll just wait till then. But like I said, most of the time the market is going up, and so usually what happens is you miss out on that opportunity and now you have to buy in more expensive down the road. Don't check your portfolio every day. It's not a TikTok, it's a tree. Let it grow. Section number 5, this is going to be how your $10,000 actually grows. The power of time plus compounding isn't flashy, but it's real. The portfolio that I just explained for you when I went over the entire pie chart could get you returns upwards of 20%. In 2023 and 2024, my portfolio that I actually invest in got over 35% each year. I wouldn't be surprised if on average the portfolio that I just described for you gets an average of 15% per year over the next 20 or 30 years, especially because it's so dominant in that technology and AI space, while keeping you safe so that your portfolio doesn't make too big of drops, so that you don't have to climb back up out of holes. So 15% seems kind of crazy, especially if you've been investing for a while and you think that that number is just a little high. But based off my calculations and based off where I think the market is going, and with inflation rising as fast as it does, I don't think that that's that crazy anymore. To be more realistic though, I'm going to show you what it would look like if we did hit that 15% over the next 20 years, but also just something a little bit more realistic, like I said, at 10%. So you can have just kind of a lower estimate and then maybe a higher estimate so you can have a good idea of where this money could go. Let's say you have this $10,000 invested and you don't add another dollar and it returns at 10% per year. In 20 years, that $10,000 will have grown to $67,275. Amazing. Let's say you have this $10,000 invested and you don't add another dollar and it returns at 15% per year. In 20 years, that $10,000 will have grown to $163,665. That's a pretty big difference. The quickest way to make your investment grow faster and larger though is to make sure you're adding at least a little bit to it each and every month. If we went with the smaller possible interest rate, but instead we just add $500 per month now in 20 years, this one goes all the way to $410,925. And just for fun, let's try that same 15% example. Starting with $10,000, adding $500 per month for 20 years at 15% would get you $778,326, all from just $500 extra per month. Section 6 is very important, and this is when to adjust. When do we actually change up the percentages within the portfolio? So first and foremost, you have to pick what percentages make sense to you. I kind of gave you a generic example, but for each person it's going to be a little bit different. Some people don't want to add in the super high risk speculative plays, so they'll take that 10% and just add it to regular growth. Or they don't want to have any extra cash or just pure safety down at the bottom, and maybe they'll want to add that to the S&P 500 or something. But the main thing is the way that you invest now and maybe over the next 10 years may change 10 years from now when you have different life changes. So possibilities like when you get married or have kids or you want to buy a home. Your goals have shifted, especially short term, so you need to update your plan. Or your risk tolerance shifts. This usually happens in certain life stages and especially in retirement. But remember, this is your portfolio. You need to build it out to make it so that you are comfortable and so that you can sleep at night. Whenever I talk with my clients and they say, what should I invest in, or how much should I put in this category versus this category, or should I pay off my house first or invest more? I always put the question back on them. What is it that's going to make you feel the most comfortable? Do you want more safety? Would you like to have a bit more risk for that possible upside? Know your personality and know what's going to work best for you. And if you need any help with that, you can always email me and we can set up a one-on-one consultation and I can help you work through this. You don't need to be a stock picker. You don't need a finance degree. You just need a system and the patience to let it work. In this video here, I go more in depth in the big 3 categories within the portfolio that I recommend and that I talked about here in this video a little bit, but I go much more in depth there. Or watch this video on everything that I've learned over the last 18 years in investing and what I've learned with my private clients that have been investing for 50+ years. And as always, remember to keep investing simplified.